When most people think of the Kardashian, Jenner fortune, they picture Skims shapewear or Kylie's famous lip kits. But those headline numbers, $1 billion valuations, sold-out launches, are just the glossy surface of a financial structure as sophisticated as any multinational corporation. Let's start with the obvious. Kim Kardashian's Skims is now valued at more than $4 billion, thanks to private equity funding from firms like Thrive Capital. Kim retains a majority stake, which means she doesn't just earn from sales, she profits when the brand raises capital and when it eventually goes public or sells. This is classic venture capital strategy, used by Silicon Valley startups, now perfected by a reality TV star. Kylie Jenner followed a similar path with Kylie Cosmetics. After skyrocketing to nearly $600 million in revenue in just a few years, she sold 51% of the company to beauty giant Coty in 2019 for $600 million in cash. Critics debated her self-made billionaire label, but the move was textbook wealth creation. She cashed out half, kept a lucrative minority stake, and gained global distribution without risking her own capital. But the real brilliance lies in what we don't see. Behind each brand is a web of LLCs and holding companies registered in Delaware, Wyoming, and abroad, jurisdictions famous for favorable tax treatment and privacy. Public records show dozens of entities like KKW Holdings, Kylie Baby Incorporated, and 818 Holdings LLC, each designed to isolate risk, protect trademarks, and minimize taxes. It's the same architecture used by Fortune 100 companies, simply scaled to a family of media moguls. Their real estate strategy is equally calculated. Over the past decade, Kim, Kris, and Kylie have quietly accumulated luxury properties across California, Hidden Hills, Beverly Hills, Palm Springs, often buying through trusts to shield their names. These properties aren't just homes, they're appreciating assets and collateral for future business ventures. When they renovate and feature the results on TV or social media, property values spike even higher, essentially turning lifestyle content into capital gains. Then there's the equity hustle, the investments that rarely make headlines. Industry insiders confirm that members of the family hold silent stakes in startups ranging from plant-based foods to fintech apps. Rather than mere sponsorships, they negotiate equity for their promotional power. One well-placed Instagram story can drive user growth overnight, increasing their stake's value without them spending a dime. Tax planning? Immaculate. With income streams flowing from licensing, speaking fees, brand dividends, and appearance deals, the Kardashians employ elite accountants who navigate deductions for production costs, travel, and even certain wardrobe expenses. They aren't breaking laws, they're optimizing the code, a move available to any billionaire but perfected by a family once dismissed as tabloid fodder. The TV show itself is a profit center and a marketing funnel. The original Keeping Up with the Kardashians reportedly earned the family about $30 million per season by its later years. Their Hulu deal, estimated at $100 million, ensures continued visibility, which in turn drives sales across every other venture. In business terms, their reality content is both advertising and cash flow. Another layer: licensing and intellectual property. Every name, phrase, and logo, from Kardashian Collection to Kimono, the short-lived precursor to Skims, is trademarked. Those marks can be sold, leased, or used as collateral for loans. Even a cancelled project can still earn through licensing fees and merchandising rights. Critics argue this relentless monetization fuels overconsumption and sets unrealistic wealth goals for followers. Supporters counter that the Kardashians have merely mastered the opportunities available in a digital, celebrity-driven economy. They built an attention-to-equity pipeline, capture eyeballs, convert to sales, then convert sales into long-term investments. Perhaps the most telling fact is how resilient the model has proven. During economic downturns or media backlash, product sales might dip, but the family's diversified assets, from stocks to real estate, keep the cash flowing. As one venture capitalist told Forbes, they operate less like a reality TV family and more like a private equity firm wearing designer heels. So when headlines trumpet a single billion-dollar valuation, remember, that's just the public tip of a vast financial iceberg, one built on strategic partnerships, airtight contracts, and a deep understanding of how attention becomes wealth. Next on Under the Gloss, we'll examine the hidden cost of that wealth, from accusations of worker exploitation in overseas supply chains to the environmental toll of constant product drops and lavish lifestyles. Loving the story so far? Go ahead and subscribe, it's free, and it means you'll never miss the next update.